In this video, I want to take us through what is meant by the Jensen Alpha measure. And before I really do that, I also want to focus in on what we mean by the risk-adjusted rate of return in finance. And this incorporates what is referred to as a capital asset pricing model, specifically what we mean by a stocks beta or a portfolio's beta. Now, in regard to the capital asset pricing model or the CAPM, what we do is that we correlate a portfolio or a stocks return to the overall market return. And what I mean by the market, it would be the return, say, for the S&P 500, the Dow Jones Industrial Average, or the NASDAQ. Now, the beta for the market, i.e. Dow, S&P, NASDAQ, will always be 1. So that becomes a so-called benchmark. We also refer to that as a risk factor. So if we know the market has a beta risk category of 1, and if our portfolio or stock has a beta of 2, that simply means that our portfolio or our stock is twice as risky, volatile, price-wise, as the market happens to be. As I pointed out, the market, Dow, S&P, NASDAQ, will always have a beta or risk factor of 1. So that's very important. So going back, how do we determine a beta? A beta is nothing more than the slope of a line. And so in other words, when we relate or we correlate, we'll say stock ABC against the market over time, the stock ABC will be our so-called dependent variable, and the market, say the S&P 500, will be our independent variable. So what we're talking about here is that, in other words, when we do a regression analysis, i.e. from the standpoint of regressing our stock ABC against the market return, we're talking about a linear expression, the old good old-fashioned algebraic expression for a straight line, a plus bx. Now, b is the slope, that relationship, and the slope is what we refer to as beta, as risk. So that's really what we're trying to calculate, and that's what we're trying to incorporate into this Jensen Alpha measure and into this capital asset pricing model for beta. So I know that's a quick overview. You can kind of read a little bit more about that in the text, but I just wanted to bring that to the forefront right now. So when we look at this Jensen measure here and the alpha here, so really what we're trying to look at, what we're trying to calculate is my stock or is my portfolio, is it giving me a positive alpha from the standpoint of the risk taken in relation to the return? So when I look here from the standpoint of the Jensen Alpha, that it will be equal to the actual portfolio, the expected total portfolio return. That could be from my stock, or that can be from a portfolio, mutual fund, or whatever it would be that I have. Minus, and here what we're talking about is really the capital asset pricing model. That's what we refer to as the risk-adjusted rate of return. The risk-adjusted rate of return. And that is equal to the risk-free rate, and that is usually a 90-day treasury bill, plus the beta for that portfolio. That's what I was just concluded talking to you about, times what we expect the market return to be, and once again, that would be the Dow, the S&P 500, or NASDAQ, minus the risk-free rate of return. See, when we look at the capital asset pricing model, I have some alternatives. I can invest in 90-day T-bills, which would equate to zero risk. There is no risk associated with 90-day T-bills. Or I can invest in a basket of stocks, Dow, NASDAQ, S&P 500, and that will have a risk factor of 1. So I can focus in on nothing but treasuries, zero risk, or I can factor into the market has a risk factor of 1, or any other portfolio that could have a risk factor less than 1, or somewhere between 0 and 1, or something greater than 1. So when we look at this risk-free rate plus beta times the quantity of the market rate of return minus the risk-free rate of return, this right here is really what we mean when I'm making reference to the risk-adjusted rate of return. That is synonymous with K, i.e. from the previous chapter when we talked about the dividend discount model, right? Dividend discount model from the standpoint was the expected dividend divided by the quantity of K minus G. K we quantified or we identified as the required rate of return. So when we're talking about the risk-adjusted rate of return, that would almost be synonymous with what we refer to in the dividend discount model as that K. So that's just kind of a quick overview. Focus once again on the Jensen Alpha measure is equal to the actual or expected return from our portfolio or stock minus this risk-adjusted rate of return. If we come down here, kind of look at an example, and here I'm just giving a further explanation by way of investor media, what they mean by the Jensen portfolio. But what I want to draw your attention to here is right here. Let's say, for example, if there are two portfolios that both have a 12% return, a rational investor will want to find the one that is less risky. Well, again, what we're assuming here is that we have two portfolios. We'll say A and B. They each have a return of 12%. Are we going to be indifferent to those portfolios? No, and the reason B is that some portfolios, some stocks, do have greater risk than others if we are identifying risk by way of its beta. So here we look at two portfolios at 12%, and then I'm going on and I'm saying, okay, let's make an assumption here. Let's assume that the market, and we'll look at the market from the standpoint of the S&P, has an expected return of 10%. So right off the bat, you might say, oh, my portfolio, right? I got A and I got B, is 12%. The market is only going to return or expected return of 10%. Hey, I should be okay, right? 12 is greater than 10. Well, not so quick to make that assumption. And then I go on and I say the underlying 90-day T-bill is 1%. Where I'm going with this is that this is the information that we will utilize in order to calculate the Jensen Alpha measure. We want positive alphas. If we have positive alphas, that means the stock is outperforming the market given the risk taken. If the Jensen Alpha measure is negative, that simply means that we are underperforming the market given the risk taken by that stock we have invested in or by, we'll say, the portfolio that we have. So let's kind of look at the situation here, and you can see I have portfolio A, 12% beta of 1. So we can say, okay, portfolio 1 is kind of a mirror image of the market, S&P, the Dow, or the NASDAQ. And portfolio B, of course, 12%, and it has a beta of 2, twice as volatile as the market. So in that particular calculation, focusing in on what the alpha measure is for A, right? It's 12%. That's what we expect the return to be for our portfolio, minus the risk-adjusted rate of return, right? 1% plus 1 times the quantity of the expected market return minus the return on 90-day treasuries, and that equals 2%. So when we look at, the Jensen Alpha measure for A, we come up with a positive 2%. So therefore, this portfolio A, given its risk, has definitely done a better job performance-wise than the market, as indicated here by the S&P. So if we look at it for B, well, in this case, we're expecting 12%. The risk-adjusted rate of return, we got that beta here of 2. So 1% plus 2 times the quantity of what we expect the market to do minus this 1% will give us a minus 7. So once again, in other words, this particular portfolio B has underperformed the market given the risk. See, in each case, 12%. Let's just look at B. Yes, B, 12%, had a greater return than what we expected the market at 10%. However, when we take into account risk, that was a major underperformer by 7%. So hopefully this helps clarify any issues that you may have had with the Jensen Alpha measure, but at the same time, I definitely wanted to incorporate this CAPM, or really what we mean by a risk-adjusted rate of return.